Hello and welcome to this AFM pre-September 2022 mock exam on La Montagne. My name is Alan Lynch and I'm your expert tutor for today. I think for everybody's benefit, we'll just refer to this question as La Mon going forward. A couple of things before we get into the question. I'd like to get across some of the key points in an AFM exam. If you've seen other videos on this, you'll see them in more detail, and I would recommend that you look at the other two videos on question 1 and question 2. But briefly, what are the key parts that you have to know about an AFM exam? The first one is time management. Manage your time according to the marks. It's a great benefit now that the professional marks are worth 20 marks. In theory, the ACCA is giving you extra time to do your exam. So you need to reward the examiner back and appropriately use that time. So you need to split the amount of marks for each question down by the amount of time. Never go over that time. And in fact, use the extra time you're being given by the professional marks and stay with what it used to be. 10 marks is around 18 minutes. And maybe give yourself that buffer to fill in additional information at the end or check those calculations at the end. But again, this only comes with practice. You can't just assume time management works today. You have to practice it every day so it works efficiently in your exam. The second one is ACCA AFM exam is a narrative exam as well as a calculation exam. And I often start like that is not a calculation and narrative, it's a narrative exam with calculations involved. And without doing those narratives well, I'm giving them the concern, the thought and the effort and the concern that they deserve, doing the proper layout, getting those professional marks, because that's where you're getting a lot of your professional marks from. All of your efforts and sweating and panic with the calculations really won't get you to that pass level. I think it's one of the biggest issues and biggest problems that people have with AFM is they ignore those key marks that come from the narrative section of the paper. You also need to read the questions carefully and read the requirements carefully. Don't tell the examiner everything you know about a topic. Don't fall into that trap where you rewrite 3 pages from a book. What you want to do is answer the exact question asked, always related to the case study as best as you can. If you're doing something, even from a narrative or a theoretical perspective, that doesn't make sense in the case, you're going in the wrong direction or you're providing additional information. Remember, if a section's worth 5 marks, it's usually 2 to 3 really well-explained points. If you find yourself on point number 6 and 7, it's only 5 marks, you've wasted a lot of time. You could only get a maximum of 5 marks. And you're just going to have a massive knock-on effect for the rest of the time. Next, and finally, you need to practice using the CBE tool. I will show you today how I use the CBE tool. I'll show you how I have a strategy for answering questions, not keeping the screen too cluttered, being able to have access to everything. Just follow what I do today. And then as you practice, you'll come up with your own way. My way isn't the only way, but it is an initial guide that you can use. And then you can adapt it. So when you do get to exam day, where you put the word processor, where you put your spreadsheet, how you gain access to your exhibits, that's all second nature. That will just come naturally. You shouldn't be wasting any time in your exam. So now we're going to move on and go through the Le Mans question in a little bit more detail. So now we move into the main body of the Le Mans question. A few things to do. We've covered that in previous questions. The first thing you do is take the requirements and copy them into your word processor and just tidy them up a bit and make them readable. Also, I talked earlier about strategy. So look how I've set up the word processor, look how I've set up the spreadsheet. You don't have to copy this, but come up with your own version. Keep your workspace nice and clean and tidy, always giving yourself access to the exhibits, requirements, and the response options on the left-hand side. So first of all, we start talking about the requirements. So part A is calculate the results of the hedging strategies that are being considered for the 10 million of borrowing. If the bank base rate increases by 1% or decreases by 1%, show all relevant calculations and comment on your results. And that's 15 marks. Discuss the advantages and disadvantages of Le Mans companies setting up a centralized treasury function. That's 5 marks. And then there's professional marks awarded for skills in analysis and evaluation and commercial acumen. So let's have a look what's in our exhibits. Again, tidy up your exhibits, make them So if you're going to have one using your word processor, you can keep it beside you. If it's relevant to your spreadsheet, you can keep it beside you, or you can flick from one to the other if that's necessary. Le Mans is a large multinational company, grown rapidly over the last few years and now has subsidiaries in several countries. Today is the 1st of June. The finance manager of the South Asian subsidiary is reviewing the subsidiary's forecast for the next few months and has identified there will be a short-term deficit of cash starting 31 October. She is therefore planning to borrow $10 million for a 6-month period starting 31 October. The base rates in South Asia are 4%, and the company's credit rating is such that it pays a spread of 20 basis points on its borrowings. There's been a lot of volatility in recent months, and the finance manager thinks there's a possibility that the bank base rates could increase by 1% or decrease by 1% before 31 October. She's therefore keen to hedge against the risk using traded derivative products. Part 2. The following market information is available: the futures contracts, prices for 1 million 3-month contracts. Options over December future contracts, they're 1 million 3-month contracts. The premium is quoted in percentages. And it can be assumed that the settlement for the futures and options contracts is at the end of the month and that the basis diminishes to 0 at contract maturity at a constant rate. The South Asian subsidiary finance manager is concerned that the options over future contracts are very expensive to set up and feels that the head office finance team would not authorize the expenditure and the premium payable. Therefore, she wants to explore the possibility of a futures hedge and a collar hedge, but not a traditional options hedge. So what's the first thing we're going to do in this question? So I think firstly, there's a lot of calculations, and I think we get straight into the calculations. Remember, if we go back to our requirements, and in our requirements, we're asked to calculate the results, and that's 15 marks, and comment on your results. If we just have a quick look at the question in a little bit more detail, first one, I would say the comments are worth about 3 marks. So therefore 3 points. But if you think of your 15 marks, you have about 28 minutes. So of that 28 minutes, you're probably looking at 24 minutes doing your calculations, and then the remaining time writing your few comments. Your comments are based on your calculations, so they're relatively straightforward. Part B for 5 marks is the advantages and disadvantages of Le Mans setting up a centralized treasury function. Pretty straightforward. 2 to 3 marks of advantages, 2 to 3 marks for disadvantages. I would say it's 1 to 2 marks per each relevant point and 2 points each to be sure. So you might be doing 6 points, 6 marks of work. Guarantee your 5. It's very straightforward. What you want to do is make sure you don't overwork for that. So you don't want to make 4 or 5 points or 5 or 6 points. You can only get a maximum of 5 marks. These professional marks are awarded for demonstration of skill in analysis and evaluation and commercial acumen. What does that mean? Well, you're using your data to draw conclusions and you're being objective and able to use examples. So let's get straight into the calculations. Anything in red here, I've just provided for a little bit of context and background. If you watch this video back and go through the solution slowly, you can use that as a guide. What I would like you to do after this is to take a nice, clean CVE tool and try and do this question as well as you can, then compare to the answer, use the video again, and make sure you understand all of the concepts. So what's happening? We need to borrow 10 million on 31st of October and in 5 months' time for a period of 6 months. So what do we need to do? We need the futures hedge. So we need to set up the hedge by looking at 3 key issues. Borrowing, so we're selling futures, we're going short now. The number of contracts is 10 million contracts divided by 1 million, which is 6 months multiplied by 6 months divided by 3 months. So it's 10 multiplied by 2, which is 20 contracts. The futures expiry date will have to be December. Both June and September contracts will have already expired by the date of our transaction. Therefore, we need to contact the exchange and tell the traders we want to sell 20 December future contracts. Now let's look at our basis working. So now it's the 1st of June. Our transaction is on the 31st of October and the expiry date is the 31st of December. Our base rate is 4%. Our futures price. So now we've got all of this information provided in our exhibits. So December futures price is 95.16. The basis is 100 minus the 4%, which is the base rate, minus the 95.16, which is the future price, giving you a basis of 0.84. Your 0.84 divided by 2/7, which is the 5 months that we've talked about in 5 months' time, giving you 0.84 divided by 2/7 gives you the basis of 0.24%. So now the closing future prices can now be calculated by incorporating this unexpired basis. So if the base rate rises to 5%, our closing futures price is 94.56, which is 100 minus 5, because the rate is 5%, minus 0.24, which we've calculated earlier. If it reduces to 3%, I'm going to just fix that now. It's 96.76, which is the 100 minus 3, which is the 3%, minus the 0.24, again, calculated above as the basis. That gives you 96.76. So if the bases rise to 5%, what is the interest payable? Well, the interest payable is 0.052 multiplied by 10 million divided by 6/12, or 5.2%, which is 260,000. We're going to sell at 95.16 as per your exhibit. We're going to close out at 94.76 as we calculated earlier. Your movement is 20,000, which is the 95.16 minus the 94.76 multiplied by 20 million, or 20 contracts, multiplied by 1 million and multiplied by 3/12. And that will give you, and again, you can use the calculations that you've done to link them in, giving you a total of 240,000. So it's the interest of 260 and the movement of positive 20, giving you an effective interest rate of 4.8%. And that 4.8% is the 240,000. That's for 6 months. So the 240,000 multiplied by 2, annualizing it for a full year, divided by the 10 million, giving you 4.8%. You can copy this calculation down and just use the same approach. The interest payable is 160,000, which is 3.2% by 10 million for 6 months. You can sell at 95.16 per the exhibit. We can buy at 96.76 as we calculated earlier. Again, the movement is the difference between the two, multiplied by 20 contracts, multiplied by 1 million by 3/12, giving you 80,000, and giving us a total for the 12 months, which is 240,000, and then giving you the effective interest rate of 4.8%. So the effective interest rate is the same for both. Now we look at the collar hedge. For a borrowing, we sell futures or we buy put options. Therefore, to set up a collar, we buy put options and simultaneously sell call options. Using the given strike prices, we'll need to buy 20 December put options at 95 and simultaneously sell 20 December call options at 95.50. And again, in your exhibit, you can see the 95 and the 95.50 as the strike prices for the calls and the puts. And again, this description in the collar hedge is just to provide you some context. You don't necessarily need to write little notes to yourself, or if you want to write a bit of logic, but don't go into the amount of detail I have here. This is for you looking at later on. When we're calculating the premium payable on the put options is 0.25% multiplied by the 20 contracts, multiplied by 1 million, multiplied by 3/12. The premium receivable on the call options is the 0.22%. Again, the 0.25 and the 0.22 you're provided in your exhibits, multiplied by the 20 contracts, multiplied by the 1 million, which is for each contract, multiplied by 3/12 as they are 3-month contracts, giving you 11,000. And then the net premium is 1,500. What are the results of the collar hedge? If it rises to 5%, if it rises to 5%, we have the 260,000, which we've calculated earlier. The difference between our put, choose to sell at 95, choose to buy at 94.76. So we have a 0.24% gain, which means we exercise. Exercising that at 20 contracts by 1 million by 3/12 gives us $12,000. The future markets, the calls sold to the counterparty, there's a 0.74% loss, So the counterparty will lapse. The premium is $1,500 as we calculated. So the minus 260 plus 12 minus 1,500 gives you 249,500, an effective interest rate of 4.99%, calculated the same way as we looked at earlier, doubling it up over 6 months, dividing it by the full 10 million. If the rate goes to 3%, the interest payable is 160,000. On our put, we make a loss of 1.76, so we're allowing it to lapse. On our future markets, which is our call sold to our counterparty, there's a 1.26% gain between the 95 and the 96.76. And therefore, we have a loss, which is our loss of 63,000. It's their gain, it's our loss. The premium is 1,500. So the 160,000 less the 63, less the 1,500 gives us a loss of 224,500, or an effective interest rate of 4.49. So what have we calculated in this question? The effective interest rates, the results of the collar hedge, and we also have the effective interest rates of the futures hedge. So now we move on and we make our comments. So our comments are, the futures hedge will lock in the interest rate to 4.8%. And again, we have these calculated across the way here. This would be the preferred approach if the finance manager wants to completely eliminate the risk associated with interest rate movements. Having said that, the calculation assumes there's no basis risk, i.e. the basis will diminish to zero before expiry date. In reality, it might move in a less predictable way, meaning the unexpired basis may not be exactly 0.24 on the 31st of October, and there could be some inefficiency with the futures hedge. Also, the calculation here has ignored the margin requirements associated with future contracts. Margins mean the day-to-day monitoring and processing associated with futures contracts is more complex than we have shown here, even though ultimately they don't affect the financial result of the hedge. But again, there could be some operational costs associated with that. The collar hedge is definitely complex to set up and more complex than a traditional option, but it does enable the company to benefit to some extent from favorable interest rate movements while also protecting from downside risk. The calculation showed that the premium is very small, so the flexibility by the collar looks attractive. Whether the finance manager chooses a futures hedge or a collar comes down to the company's attitude to risk. Does the company want to pay a small premium to give flexibility for the collar, or use the cheaper approach in the futures to eliminate, well, almost eliminate risk completely? And that's your analysis, that's your professional mark in there as well. For 5 marks, the second part is discuss the advantages and disadvantages of Le Mans setting up a centralized function. The advantages means that its highly qualified staff could be employed, so their expertise is better. There'll be no longer duplication of roles and higher costs in each of the company's units. Because the company's net position will be better understood, there might be further cost savings by netting off surpluses and deficits to avoid higher interest charges or expensive hedging techniques. The centralized function will be closer to the management, so better understand the group's strategic objectives, be greater goal congruence. At the moment, the finance manager in the South Asian subsidiary isn't sure what the authorizations limits are for setting up an options hedge. The chances of this happening will be lower with a centralized function. A centralized treasury function operated by highly skilled staff could also run as a profit center, and they could use derivative products in a clever way. The disadvantages include the centralized function will be less responsive to problems in individual subsidiaries, and the finance manager of each business works in the business unit to make sure this is in control. And removing this responsibility from local staff and taking it to a centralized function would reduce the autonomy of the individual business units. This would reduce the motivation of local staff and perhaps cause them to leave. It's a very simple answer to that. Now, before you finish up, we delete any of the content that was left in the question or that was provided in the question. The examiner should only be seeing the work that you have done. We get rid of all of my earlier notes and we're just left with a very neat answer. Your calculations on the left-hand side for part A, and then nicely laid out part B. And you're also picking up some nice professional marks for that. So all the best in your future exams.